Another day, another story. Financial statement fraud refers to the deliberate misrepresentation of financial information to deceive stakeholders, such as investors, creditors, and regulators. This type of fraud can have severe consequences for organizations, leading to damaged reputations, financial losses, and even legal repercussions. Understanding the common methods of financial statement fraud, as well as implementing effective detection and prevention measures, is crucial for maintaining the integrity of financial reporting. We will explore the various methods of financial statement fraud, examine ways to detect such fraud, and discuss preventative measures with detailed examples. Common methods of financial statement fraud. Revenue recognition manipulation. One common method involves inflating revenues by recognizing fictitious sales or prematurely recognizing revenue before it is actually earned. This can be done through various means, such as creating false invoices, recording sales without corresponding shipments, or manipulating sales cutoffs at the end of reporting periods. A retail company inflates its revenue by recognizing sales made to shell companies owned by its executives. These fictitious sales artificially boost the company's financial performance and deceive investors and creditors. Expense manipulation. Expense manipulation involves understating expenses to inflate profitability. This can be achieved through improper capitalization of expenses, overstatement of assets, or deferring expenses to future periods. Another example is, a manufacturing company capitalizes normal repairs and maintenance expenses as long-term assets. By doing so, they inflate the value of their assets and present a better financial picture, deceiving potential investors. Overstatement of assets. Fraudsters may overstate the value of assets to boost financial ratios, such as return on assets and equity. This can be achieved through inflating the value of inventory, property, or intangible asset. A company inflates the value of its inventory by including obsolete or unsellable items. By doing so, they overstate their asset value and mislead stakeholders about the company's financial health. Detecting financial statement fraud is done through data analytics. Employing data analytics techniques can help identify patterns, anomalies, or inconsistencies in financial data. By analyzing large volumes of data, auditors and financial professionals can detect unusual trends, disproportionate changes, or outliers that may indicate fraudulent activities. An organization notices a sudden spike in revenue in a particular quarter without any corresponding increase in sales volume or market demand. This anomaly raises suspicions and prompts further investigation. Internal controls and segregation of duties. Establishing strong internal controls and segregation of duties is crucial for preventing and detecting financial statement fraud. Implementing checks and balances ensures that no single individual has complete control over financial transactions and reporting processes. A company separates the roles of authorization, recording, and custody of assets. This segregation helps prevent collusion among employees and minimizes the risk of fraudulent activities going unnoticed. Preventing financial statement fraud is done through ethical tone at the top. Promoting an ethical culture within an organization starts with leadership. Management should set the tone at the top, emphasizing integrity, transparency, and adherence to ethical standards. Strong ethical values act as a deterrent to fraud and encourage employees to report suspicious activities. Company CEO publicly emphasizes the importance of ethical behavior and holds regular training sessions on fraud awareness. This creates a culture of accountability and discourages fraudulent activities. Regular internal and external audits. Conducting regular internal and external audits is crucial for identifying and preventing financial statement fraud. Auditors review financial records, internal controls, and processes to ensure compliance with accounting standards and regulatory requirements. An external audit firm performs a thorough examination of a company's financial statements, uncovering irregularities in expense reporting and exposing fraudulent activities that would otherwise go unnoticed. Those are excellent points on detecting and preventing financial statement fraud. Here are a few more strategies. Comparing financial data across different periods or benchmarking against industry peers can reveal inconsistencies or deviations that may indicate fraud. By analyzing key financial ratios, trends, or benchmarks, auditors can identify unusual patterns or outliers. A company's profit margin significantly exceeds industry averages without a clear explanation, suggesting potential manipulation of financial results. Forensic accountants employ specialized investigative techniques to detect and investigate financial fraud. They analyze financial data, reconstruct transactions, and identify hidden patterns or evidence of fraud. A forensic accountant reviews a company's financial records and uncovers fictitious transactions, forged documents, or hidden accounts indicating fraudulent activities. Preventing financial statement fraud. Whistleblower hotline. Establishing a confidential and anonymous reporting mechanism, such as a whistleblower hotline, encourages employees, customers, or vendors to report suspicions or fraudulent activities without fear of retaliation. This can help detect fraud early and prevent further damage. A company implements a whistleblower hotline that allows employees to report potential financial misconduct, providing a safe and confidential channel for reporting concerns. Fraud risk assessment. Conducting regular fraud risk assessments enables organizations to identify and mitigate potential vulnerabilities or weaknesses in their financial reporting processes. It helps prioritize resources and implement preventive controls to address specific fraud risks. A company conducts a comprehensive assessment of its financial reporting processes, identifies areas of high fraud risk, and implements additional controls and monitoring mechanisms to mitigate those risks. These strategies, when combined with a strong ethical culture, thorough internal controls, and ongoing monitoring, can help organizations detect and prevent financial statement fraud. It's important to note that no single measure guarantees prevention or detection, but a combination of these strategies strengthens an organization's ability to identify and mitigate the risk of financial statement fraud. Thanks for watching.